Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Tuesday. We've got an oddly truncated week where a day after tomorrow, we've got a bank holiday, but today we are dealing with what was a pretty interesting session where all four of the indices had a little bit of well, let me show you here. We were looking at some interesting longer term setups for most of December, and then we shifted gears as of the early part of this month for two reasons. One, we don't have as many trends as we had even just 4 to 6 weeks ago. Number two, we know that there's going to be the markets are closed on Thursday. And number three, we know we have non-farm payroll on Friday. So that's a reason for some money to sit on the sidelines before it gets to work. Looking for some insight into the second most important metric that the Federal Reserve looks at, which is what is the employment picture. It's easy to forget with as much emphasis as there is on inflation that the employment picture is a big part of the dual mandate of the Federal Reserve. So Powell and company, whether they like it or not, have got to keep an eye on things like JOLTS. They've got to keep an eye on things like initial claims. And they most definitely have to keep an eye on things like non-farm payroll. So this morning, we're seeing a little bit of strength as we go into the bell. And by strength, I mean, for the most part, what I'm looking at are the indices trading above yesterday's previous session close. There's a number of levels, and I've called them lines in the sand because they're quite literally a specific demarcation where in my opinion, shifts oftentimes from bullish to bearish or from containment to expansion, right? There's certain lines on a chart when broken, the way that we'll respond is markedly different than if they were not broken, hence a line in the sand. And the easiest one that I've taught forever is the previous session cash close or the 4 p.m. Eastern close. There are others. They start to get a little bit more difficult than simply where was the cash close the previous session, but things like an anchored VWAP, right? Things like an anchored VWAP can give you a lot of insight into the sentiment, that line in the sand according to price and volume. So there are a few of these that I look at, but those would be two really pretty easy ones to focus on. And when we're above those, I'm generally going to be bullish. Yesterday was a very bullish day. We stayed above the previous session close pretty convincingly. And the probability of follow through to the upside above that level for my day traders out there is usually a whole lot better than if we're not above that level. All right. So as always, if you have any questions, feel free to type them on in. We'll take a look at those symbols together. Let me also mention, I think today's Tuesday, right? I've been losing track of the days since Christmas. So today's Tuesday, which means I'll be doing the free and premium video over at the Simpler Trading YouTube channel. So for those of you watching Charts and Coffee, most of you are probably there already. For those of you that are watching on my channel at Raghee Horner, check out the Simpler Trading channel later on today. Because what I'm going to do, and I promise that I'll be doing this throughout January, I'm going to start to share with you all a little bit more detail as we go through the whole year. But I thought, we'll go through a little bit quarter by quarter, but there's a couple things that I want to make in the beginning of this year a really important point. Imagine yourself 12 months ago, and my Sector Secrets Mastery folks, this is what we were doing. So imagine 12 months ago, Q1 of 2024, which is markedly different than Q1 of 2025. My goal here is for everyone to prioritize, really one thing if I could, find the trends. And the reason being is follow through within the context of a trend is going to be so much better. This was Q1, and you can see by the date here, 0101 to 0331. So this is Q1 of last year. And we're going to go through the quarters. We're going to go through the entire year throughout January. This is what we did in Q1. And the starting account size for January was, I believe, 58,000. The starting account size for February was roughly the same. So it was every month I reset to roughly 55 to 60,000 in this account. And by the end of March, we were up nearly 200. Is this great trading? Is this a super secret squiggle of an indicator or some magical formula here's the magical formula. Ready? Don't tell anybody. Wait for trends And when they're there, trade them really hard. When we have alignment, and in this case, we had the anticipation of the Federal Reserve cutting rates. Mind you, that was Q1. This didn't start until September. So the anticipation of something is oftentimes even better than the thing itself. The getting is often better than the having, right? So in this case, we were anticipating those rate cuts, and you saw the way Q1 behaved. There's always going to be the opportunity to find trends. Sometimes it's going to be as vast, and it was just an embarrassment of riches in Q1 of last year because everything was moving higher, almost 2020-esque. Now, as the year progressed, different sectors started to find their footing. Different sectors started to outperform. We had a period of time where regional banks and financials, the Russell, were really outperforming, and tech was sort of lagging. And things, things had their time in the sun. But if your guiding principle, if your North Star of trading is money doesn't go under mattresses, therefore somewhere there's an uptrend, go find that and buy the dip. I'm telling you right now, you're going to be fine. It's not just me telling you that. That Q1 was just a time where there were lots of uptrends and lots of dips to buy. Now I'm going to show you Q2 this month too. That was my most challenging quarter of the year because the number of trends we had weren't as many and the volatility kicked in. So, if we were to segment out a certain month or a certain quarter, we could see that there were certain outperforming quarters and there were certain underperforming quarters. When we step back and look at the year in its entirety, yes, we ended the year higher. But one of the things also that I want to emphasize, apart from let the North Star of your trading be finding trends, preferably uptrends, the other one should be a lot of what we are able to take out of the market is what it gives us. If you go to the grocery store and the shelves are empty, there's not much to take. All right, I live in Florida. I know what that looks and feels like during a pre-preparation for hurricane season. The bottom line is there's more to get. There's more follow. There's more that we can take out of the market in trends. And when those trends dry up, now fast forward to where we are today, when those trends start to dry up, our watch list will naturally contract. We'll have fewer things to do. And that's a good thing. Because this way we're not chasing after Oasis. We're not chasing after 12 months ago. We're trading the market we have, not the market we wish we had. And that's another really, really tough thing for traders to adjust to. So, and I'm not saying this stuff came easy. As I embark on 2025, this is decades in the making. So maybe I can save you a little bit of grief and get you to more optimized trading, much more effective trading a whole lot sooner, without having to go through the trials and tribulations of, oh, that didn't work. I'm telling you right now, trends, especially uptrends, work, right? So that's probably the best thing that we can kind of kick 2025 off with. All right, so let's go ahead and dive into the other indices here this morning. Taking a look at the ES. The ES is not nearly as bullish as the NASDAQ. Here's the YM. Again, not nearly. I mean, this is not even bullish. The Dow is bearish. All right. So when traders are looking for the indices to all agree, realize that's a special thing. It's not a needed thing at all. The Dow does not have to agree with the S&P. It's easier when it does. But if I'm going into the Dow expecting it to behave like the NASDAQ, I'm running west looking for a sunrise. You know what I'm saying? So a lot of traders end up, again, presuming that something that's lagging is the bargain. Now, sometimes when it's lagging, there's a reason that it is. More often than not, that's the case. So for now, if you're asking me, Rog, where should I be bullish? The NASDAQ. Rog, where should I be bearish? If you want to be, which I am not. I'm unapologetically bullish, by the way, and that will far outperform any bear over time forever. It always has, it always will. And it's one of those things that, you're going to see bears paraded across television. There's always going to be some jerk out there who's setting folks up for the crash that when is it coming? When is that crash that I've been hearing about for about 3 years coming? First, it was the yield inversion. Oh my gosh. Wow. All-time highs were the result of that. And oh my gosh, Japan, that was supposed to be the end of us all, right? that didn't happen either. So please, I know that dinosaur part of our brain that doesn't want to get eaten by a T-Rex, I'm only being slightly facetious, is going to glom onto that negative stuff. The people who write those newsletters and parade across television know this. They just want your attention. They don't want to give you anything useful. Otherwise, they would tell you the markets are typically going to climb higher, go find an uptrend, buy the dip. But that would be a 30-second segment. And you wouldn't probably need to buy their goods after they say that, right? The truth of the matter is, don't be a bear, not long term. Sometimes there'll be small pockets of it, but even then, you're better off being flat than being bearish. And this isn't just my opinion. I'm going to show you 2024 throughout, like I said, this year, and you'll see proofs in the pudding. This is what we did. I'd say 95% of what we did last year were simply long calls, right? Long calls, Rog. You didn't do spreads. You didn't sell premium. No, cash account, long calls. Keep it simple. All right. It works. All right. So that's what's happening on the Dow and the Russell. They're lagging, and financials are lagging as well. Financials have been heavy. They're not nearly as bullish as, as tech. All right. Remember, gang, there's a lot of ways to look at, and this is another thing to discuss. And there always should be a little bit of a quick explainer before anyone goes into analysis. Now, if you've been watching Charts and Coffee, you know, okay, Rog, you're looking at daily timeframes and you're looking at trends on those daily. Why the daily? Because it's the most psychologically impactful time frame, not the hourly, not the 5 minute, heaven forbid a 1 minute or a tick chart. It's not the weekly. Everyone gauges. I would say the vast majority of traders and investors gauge whether they're up or down based on today's close. That's a daily chart. So the daily trend, more so than any other time frame, is going to have the most psychological impact, the most psychological importance. Doesn't mean we're going to trade the daily all the time. In fact, we're in Tesla right now based on a 1 hour short-term swing. I'd like to be nimble enough where if Tesla can move higher from where we bought it. We're actually trading TSLL. Some of our members are in TSLA. But if I take a look at a 1 hour chart, I can grab a trend, take the trade overnight, but I can keep my days to expiration on the option closer, less expensive. And more importantly, what I can do is have an exit, right? A little off ramp in terms of a target a little sooner than I typically would with a daily time frame. So I can be a little bit more nimble, but still with a slightly longer time horizon, meaning how long I could be in the trend and in the trade. So those are things that might be really helpful right now in terms of dealing with the first few weeks of 2025. Look for overnight positions, but maybe on a 1 hour time frame as opposed to perhaps a daily. I'm always looking for those daily setups. Those are my bread and butter. If someone told me, Rog, one style, one time frame, easy. Swing trading, daily time frame. And by the way, that is the most accessible time frame to every trader on the planet. You don't have to be in front of the computer all the time to do it. That's another reason I really like it, because most traders can say, yeah, Rog, I can trade a daily time frame setup as opposed to day trading or as opposed to even swing trading. All right. So let's see what we've got here in terms of questions. Good morning. Good morning. Thoughts on Uber and Lyft? I'll tell you, my main issue likely with Uber and Lyft is going to be, let's go into the IYT. All right. So when I look at the IYT, and this is a lot of where I would look for Uber mostly, it's just an ugly sector, right? It's just an ugly sector. If I take a look at when we started to bottom, in other words, here's where it could be really dangerous. Let's just dive into Uber for a moment. All right. If I dive into Uber here for a moment, and you'll see that it's been heading lower. And it bottomed out by mid-December. It's had a few up days. So my main question is basically this. Of all the things I could trade, would Uber make it on my watch list? No, it wouldn't. Is it at least no longer in a downtrend? Yes. Is it at least neutral at the moment? Those yellow candles tell me it is. So really, so much of what we trade is going to be our perspective on what we're looking for. I'm not saying mine is the only way to do it, but I would have to say only because I've got 30 plus years of saying so. This outperforms most types of thinking. And the thinking is this need or this thought to buy things when they're coming off lows. If I wanted to do that, I'll tell you, let me show you another time frame. This is where time frame and time horizon matter a lot. This is Uber on the weekly chart. So if you're saying, Rog, I get that you're a trend follower, but my objective, and this is where the communication is really helpful. My objective, Rog, in asking you about Uber or Lyft, for example, is I want to hold Uber and Lyft for the next year. I'd like to be able to hold Uber and Lyft for the next 10 years. I believe this is a, kind of an opportunity to get long on something that could get to 90 and beyond, whatever the justification is. But that length of time that you're going to be in the trade will dictate which time frame you're looking at. If you and I were talking, Bob, in middle of December, even beginning of December, and you said, Rog, I'd really like to find a way to get into Uber. I like the narrative. I just don't want to be a buyer north of 80. I'd like to find something that's a little bit more tactically a better buy. Well, two ways we could do it. One, buy one of the pullbacks within the context of the trend. And the last time we even did that was October of 2023. All right. Or, like I said, if we were talking in December, then you said, Rog, I really want to buy. I would look at one of my indicators on this weekly time frame. Notice I don't have a ton. All right. And I would say, hey, the last time we got to the first standard deviation of the anchored volume weighted average price was back on, as you can see here, the first week of August. That's the last time we did it, and did a pretty good job bouncing from there. And notice where we were again. See this? I know it's kind of a little difficult to see that gray line, but we did it again the week of the 9th, the week of the 16th of December, and even arguably for most of that month. And that was sitting in about the $58 to $60 range. So if someone says, Rog, I've got a longer term time horizon, that's what I want to take advantage of, great. But I'll tell you, a couple up days like this, no. Number one, the only way you're going to know it's heading higher is when it's already done the thing, right? When it's already sort of to leap higher. And I'm not a momentum trader. So I would leave Uber on the back burner. But those are different ways that we can look at it. And I think that's where, and Lyft is an easy, hard no, right? It's a downtrend that's moving higher. Just having a couple good days. I don't get brownie points for picking the bottom. Now, you would think watching television, that's all trading is, right? But I don't get any brownie points for picking the bottom. What I like to do is find things that are already moving higher, wait for that thing to go on sale, and engage at that point. And I think for all of us, what we have to figure out is, what is it that attracts us to getting into a certain setup? And even though we had a conversation about Uber and Lyft, please know it's the same conversation that I'm having in the Sector Secrets Mastery every day. What is the strategy that we know A, performs, and B, we're aligned with? A lot of traders who like momentum may not like my style. But if you're momentum trading and you like that style, and you've been doing it for a few years, and your account isn't growing, I guess my question is, why do you like the style? And that's where I've noticed, unfortunately, a lot of traders just like doing what they're doing. They're not really in it for account growth. And you might think that's crazy, Rog. And yet, don't listen to what people say. Watch what their behavior maps to. And sometimes that's a really hard bit of medicine we all have to take, which is what I'm doing mapping to the thing that I want? And if it's not, then I'm more in love with what I'm doing than the result that I want. And for a lot of traders, that's the trap they're stuck in. All right, gang. As always, thank you for being here for Charts and Coffee. I will see you tomorrow. Same time, same station. Be good to each other.